Welcome back to the Everything Financial Radio Show. I am Dennis Tubbergen, your host, and I'm chatting today with Mr. Karl Denninger. Karl is a prolific writer and commentator. You can read his work at market-ticker.org. Karl, we were talking a bit prior to us recording this portion of the interview today about the state of the world economy. Could you comment for the listeners?
Sure. I think that we have, from a high-frequency data perspective, that is the stuff that comes in that tells us about what's really going on, shipment rates, reports from individual corporations, and I'll focus on two, Caterpillar and Federal Express. Federal Express reported earnings and said that they are running into extreme price sensitivity problems and soft demand for their very expensive air freight service, particularly overseas. That's not a good sign at all. And then Caterpillar reported sell-through rates on a regional and worldwide basis about a week ago that were extraordinarily soft, numbers that are just terrible. And we're talking double-digit declines pretty much everywhere, including the United States, including internationally. These figures paint a picture of a rapidly softening international economic picture. That's not being picked up by people in the media nor in the stock market at the present time. But the fact of the matter is that if you've got that kind of data coming in, one of two things is true. It's either company-specific or it's a general macro-level slowdown. And when I see it coming from two market leaders, particularly Caterpillar, which is the bellwether for industrial equipment and engines, along with Federal Express, which is, of course, the international leader along with UPS that moves things from one place to another, I start to get a little concerned. We've got earnings coming up here over the next couple of weeks, and I think we're going to start to see disappointments, particularly in forward guidance out of multiple firms.
Karl, when you look at the stock market, you'd made a comment that this slowing macroeconomic picture really is not being reflected in stocks. There is one thing that I'd like your comment on. When you look at prior market highs in 2007 and the trading volume that existed then, and you compare it with trading volume that exists today, it appears that there is significantly less participation in the market from just a volume perspective than there was at a prior market high. That's typically what's known as a bearish divergence. I'd like your comment, and how do you square the market reaching new highs with really no solid positive economic news that would justify stocks reaching these levels?
Well, the divergence is something that I've noted for quite a while, and this is the conundrum, is that people say, well, there's all this money on the sidelines, and therefore, when an individual investor starts to run back in and the volume spikes back up, we're going to have this huge surge. There'll be a tremendous amount of short covering and buying, and this will drive the market, the market much higher. My riposte to that is that there's no such thing as money on the sidelines. Money is always somewhere. It is never on the sidelines. If it's under my mattress, I know exactly where it is. It's not on the sidelines. It's sitting in my mattress because I don't have anywhere better to deploy it. And if I'm not convinced that I'm going to get a fair shake in a particular asset class, I'm not going to put my funds there. There's nothing complicated about that. In terms of the view, the divergence in the market reaching highs, and why, I look at this as kind of the same thing as a junkie that's been stuffed full of heroin. He looks at the sky and says, "Oh, it's so beautiful." Well, that beautiful thing is really a thunderhead that's about to hit him with a tornado and a lightning bolt to the noggin. But he thinks it's so gorgeous because he's full of drugs. Well, our economy right now and our markets are full of drugs. They're being pumped full of heroin by Ben Bernanke out there doing his monetary experiments with quantitative easing. And so what you have at the same time is a tremendous amount of liquidity being forced into the market. The investment banks and the other big financials are putting that money into the stock market. The individual investor and consumer, on the other hand, is being squeezed relentlessly by higher costs of food, energy, health care, and other necessary goods and services that they have to buy in order to stay alive. So their disposable purchasing power is going in the toilet. And then on top of that, you have this idea that we're going to somehow restart the debt leverage cycle that led to the economic progress from 1980 until 2007. But the facts when you look at the actual data coming out of the Fed Z1 and the BEA series, is that this attempt has failed utterly, that it cannot be restarted. We've been going on attempting to do this now for 5 years. So there's a reckoning coming, and when you look at the technical picture, it is screaming top. When you look at the fundamental economic picture, you say there's no support for what's going on right now, and corporate profits have been floating higher because you've been demanding more out of employees and paying them less. But ultimately, corporate profits come from people buying goods and services. How are they going to continue to do this?
You know, Karl, I'd like to go back and just revisit something that you said. When you look at what the Federal Reserve's policies have been, it's really been an experiment. We're in uncharted economic territory. However, if you look at where interest rates were prior to the market correction of 2001, it was somewhere north of 6%, and then in Greenspan, after the 2001 collapse, reduced interest rates. After the 2008 meltdown, interest rates were reduced to zero. They've not gone back up. So assuming that we get another market correction, which I think we're both expecting, what's the Fed going to do? At that point, are they going to throw in the towel and say, we don't have any more bullets to shoot, it is what it is, we're going to go through a deflationary deleveraging period, it's going to be ugly for a few years, or are they going to try some other experiment?
I think the Fed is married to a thesis. Ben Bernanke is married to a thesis that has been disproved. Back in 2007 and 2008, my comment was that what he was going to attempt to do couldn't possibly work, but of course we knew what he was going to do because he published a paper on it, for crying out loud. I mean,
the blueprint is there, yeah.
Yeah, I mean, there wasn't any guessing as to what his experiment was going to be. He had this thesis that he had run when he was at Princeton, and this was what he was going to do. But I said at the time that mathematically this was impossible. It wasn't going to work. It might produce, some short-term palliative effects, but it was going to do substantial damage over time just because of the fundamental realities of arithmetic. Now we're 5-6 years into this experiment. It hasn't worked. That's a factual, that's no longer conjecture, no longer analysis. It's now fact looking backwards, that the leverage cycle that has driven markets and the economy in the United States over the last 30 years cannot be restarted using these policies because it has been attempted now for a consistent 5-year period and it has failed. So we now are arguing over what's the next bullet in the gun. And my guess is that Bernanke, being married to this thesis, is not going to put it down. He's going to continue to try it right up until the point at which his hand gets forced. The problem that people have is that they always there's this old maxim on the street, don't fight the Fed, as if the Fed is the most powerful thing in the world. Well, if the Fed was the most powerful thing in the world, why did we have a crash in 2008? The Fed is not the most powerful thing in the world. The market is more powerful than the Fed, always. It is simply a matter of confidence. And when that's lost, you find out what happens, and what happens is the market comes apart around your ears.
So, Karl, are you expecting then, just based on that last comment, that we're going to see a stock market decline and we're also going to see something similar happen in the bond markets? And I know the what's easier to predict than the when, but can you give us some idea as to what your thoughts would be regarding timing of those events, if I'm on target?
I think the market has peaked or is very close to having done so. The caution in what I've been saying in the analysis that I've put out and some of the recent updates that I've put out on the market on the forum and in my nightly videos is that this looks an awful lot like the Bear Stearns 2007 blow-up and 2008 blow-ups. Remember, Bear Stearns had two hedge funds that blew up in 2007 that started all the fun. Then they collapsed in early 2008. The market subsequently went on to recover not only where it was at the time of Bear Stearns' collapse, but it put another 100 handles on the S&P 500. Okay, so there was another 6-7% advance that came after that. And then everything came apart and went down the toilet. The market feels the same. Technically, it's in a different place, but from an operational and a functional position, it feels the same. It's got the same kind of artificial levitation to it. And I think that we're going to see the start of the deterioration into the summer and fall, and things are going to get extraordinarily bad from here going on forward. In terms of exactly when, that's extremely difficult. But if you've got large gains, certainly if you rode the market up and you're basically looking at being back where you were in 2007, you need to look at this and say, okay, there's been a 10% gain in the market year to date so far. How much more do you think you're going to get? And what is the risk to the downside versus the potential reward to the upside? If the market goes up another 5% and you sit it out, are you going to be less unhappy with that outcome than if you pull your money and you avoid a 40% correction?
So, Karl, where, moving ahead, in your opinion, is the safe haven?
Well, I don't know that there is one, and this is one of the problems, is that I get asked this question a lot because everybody's looking for how do I simply, what asset class do I go into and ride out the storm and not get hurt? And my answer has consistently been there isn't one. The solution to this problem is found in the political process, and we as Americans have been unwilling to get off our butt and force that solution through our government. As a consequence, all asset classes carry pretty high levels of risk right now. And if you're not a trader, this makes for a very difficult world, because it's one thing for me to say, for example, I like Sprint as a stock at the moment because I like the technical picture, I like the operational picture of the company. But that could change in a day. If the high-yield bond market goes down the toilet, Sprint is going to have terrible problems. I can take a position that I have there and I can sell out of it in the afternoon. But what if you go to work every day, or you're in a 401k and you can't do this kind of thing? You can't trade actively. Then you've got a real problem, because there is no stable place that you can go that's going to protect your wealth.
And, Karl, last question here. When do you see all this malaise, to use that term, turning into an economic recovery, and what's going to happen to get us there?
In the United States, it's very simple. Our fiscal problems, which are driving the forced contraction at the consumer level, all come from one place, and that's healthcare. That's the analysis. Nobody wants to talk about this, but that's the analysis. It's an arithmetic thing. So until we deal with that issue and we take the medical monopolies out back and literally shoot them, and I'm not being facetious here, I'm talking about literally destroying them, and force real competition into that model, let the market come back into that model, which, by the way, would take the cost of medical care down by 70 to 80% in the United States. It would cause a tremendous short-term economic dislocation, and it would also immediately make us the most competitive labor and industrial powerhouse in the world. But until that happens, we're going to continue to suffer with these kinds of distorted policies and political polemics within our economy. I don't see it happening until the pain level gets to the point that there is a mass political revolt within the general public. It's not going to come out of Washington. None of these people are even talking about this at the present time, and yet this is where the problem lies. So, in Europe has other problems. Europe has a much more diffuse base of issues. China has a much more diffuse base of issues. There, they have structural problems throughout their economy. In the United States, our problems economically are centered in one place and one place only. We fix that, we solve the problem. We don't, and we're doomed. It's that simple.
We're going to have to leave it there. Karl Denninger, thank you for joining us. The website is market-ticker.org. Hope you'll come back.
Thanks. Anytime.
Everything Financial Radio returns after these words. Stay with us.